near the end of the gold bull market like we were in 79. We're at the beginning. This is more like 71. And so gold prices are going much, much higher than, where they are now, which is around 2,660. For a pullback, it's not worth it because the pullbacks are going to be too shallow to even make a difference. And while you're waiting for it, you're going to miss it because you're going to hope for a bigger pullback than the one you get. And then you're going to end up paying more. And we still have people that didn't want to buy at 2,100, 2,200 because they wanted to dip back down to 2,000. And now it's almost 2,700. And now, well, let me see if I can get a move to 2,500. And while they're waiting for that, it's going to hit 3,000. So I'm just telling people to buy. And of course, an even better buy is silver, which is still below $32 an ounce. You have a chart of silver. Silver double topped at 50 in 1980 and in 2011. And just nominally. I mean, silver is dirt cheap on an inflation-adjusted basis.
In this interview, Peter Schiff, CEO of Euro-Pacific Asset Management, discusses the current state of the economy, emphasizing that it's in far worse shape than before the 2008 financial crisis. Schiff highlights the Fed's prolonged low interest rate policies, which have inflated bubbles beyond the housing market and led to excessive debt. He believes that another crisis is inevitable, warning that the Fed's response, creating inflation, has reached its limit, and the next downturn will likely involve a severe currency and sovereign debt crisis. Schiff explains that as inflation continues to surge and debt markets collapse, interest rates will rise significantly, and gold is already reflecting this reality. He points out that gold is on track to have its best year since 1979, and we are still in the early stages of a bull market. Schiff also stresses that silver remains undervalued, making it a great buying opportunity. He predicts that as inflation worsens, investors will flock to gold and silver as safe haven assets, and central banks will increase their gold reserves. In discussing investment strategies, Schiff advises against simply investing in stocks, especially overvalued U.S. tech stocks. Instead, he suggests focusing on dividend-paying value stocks, particularly in international markets. Additionally, he notes the untapped potential in gold mining stocks, which have lagged but are expected to soar once gold prices rise significantly. He concludes by encouraging individuals to diversify their portfolios with precious metals and value equities to hedge against inflation and a looming economic crisis. Now, we'll show you the best clips of the latest interview, but first, subscribe and hit that notification bell so you don't miss any recaps. Enjoy the episode.
Potential candidates, they're competing with one another over who can give out the most tax breaks. And then Kamala Harris also wants to spend all sorts of money. She wants to give everybody $25,000 to go out and buy a house, $50,000 to start a business, $7,000 to have a child. Where's this money going to come from, right? It's going to be bigger deficits that the Fed is going to have to monetize. Everybody's talking about tax cuts, even though we have massive deficits. People want to make the deficits bigger. Right now, the national debt is growing at $3 to $4 trillion a year. I think the pace is going to increase during the next 4 years. We could easily add 25 trillion to the national debt. I mean, it's already 36 trillion. I mean, it's growing exponentially. Interest on the national debt is larger than defense. It's over $1 trillion a year. In a couple of years, interest on the national debt will be bigger than either Social Security or Medicare, and both of those expenses are growing. But probably by the end of whoever wins this presidential election, I think that interest on the debt will consume 100% of tax revenue. And so that means that everything the government spends will have to be borrowed. And so there's no way that we can get there with the cooperation of creditors. I mean, there's a limit to how dumb the world is going to be to keep loaning money to a bankrupt nation that has no ability to pay it back and just think, well, they can print money, so we have nothing to worry about. That's exactly what they need to worry about, printing money into oblivion, where the money they print no longer has any value. That's the direction where we're heading. And so this whole thing is going to accelerate. That's why the price of gold, you talk about where it could go. It could go to 20,000. It could go to 40,000. I mean, gold prices can go up dramatically, but it's not that gold is actually changing. It's just when the country was formed in 1789, we ratified the Constitution and we passed the Coinage Act. we set the value of the dollar as a quantity of gold, and gold was $20 an ounce in 1789 when they created the Federal Reserve, in 1913, right? 120 some odd years later, the dollar, you still was $20 for an ounce of gold. So the dollar's value didn't change during those 120 years, and so you can still buy it an ounce of gold for $20. That didn't change until the 30s after Roosevelt devalued the dollar, and then you needed $35 to buy an ounce of gold, and that held until 1970, or late 1960s, early 1970s. But when Nixon finally left the gold standard, the official price was about $42 an ounce. But now it's $26.60. Gold hasn't changed. An ounce of gold is still an ounce of gold. It's just that now you need 2,660 Federal Reserve notes to buy one, whereas you used to need 20 because of how much they've created. Well, that's going to keep happening. And, so who's to say that, you may need $20,000 to buy an ounce of gold soon, the severity of the recession. And the Fed is really going to be forced to raise interest rates if it wants to do the right thing. And the government is going to have to cut spending and maybe raise taxes during this recession, which they've never done. They always try to stimulate. They increase spending. They cut taxes. So they're going to have to do the opposite of everything they've done before, which in the short run, obviously, is going to make it a whole lot worse. I mean, in the long run, that's the right thing to do when you have a recession is to cut back on government spending, and they have to let rates rise. But they're not going to do that. So that's why we're going to have a massive acceleration of inflation, which is actually going to worsen, again, the severity of the recession, because inflation acts like a tax increase. It destroys purchasing power. And so I don't think there's going to be any way out of this. I think it's just going to become, again, a dollar crisis and a sovereign debt crisis. And investors need to prepare for this in a way that, they've never probably prepared for anything in the past, because we haven't seen this. In the last few crises, the dollar is the safe haven. Everybody goes into the dollar when there's a problem. This time, the dollar is going to be the problem, and everybody is going to be fleeing it. And when you're fleeing the dollar, you're fleeing U.S. financial assets.
Yeah.
In today's news recap, silver continues to shine as an attractive asset for investors, driven by a mix of favorable macroeconomic factors. As per analysts at UBS, silver prices could see a significant rally with a potential upside of nearly 20% over the next 12 months. So the report mentions a combination of monetary easing, industrial demand recovery, and growing investor interest through ETFs as key factors that could propel prices higher. Currently, silver is hovering around 32, supported by global monetary policy easing and a weaker U.S. dollar. The recent decision by the Federal Reserve to cut rates by 50 basis points has instilled confidence in the markets that real rates will decline further. This environment of lower real rates is expected to bolster economic growth and fuel industrial demand for silver, which plays a critical role in sectors such as electronics, renewable energy, and medical technology. At the same time, the weakening of the U.S. dollar, a common consequence of falling rates, typically supports higher silver prices. UBS forecasts that these dynamics will push silver to new highs, potentially reaching $36 to $38 by next year. In addition to the influence of central banks, the broader recovery in global manufacturing is set to boost the demand for silver. As production picks up across various industries, the need for silver in industrial applications will likely increase, adding further upward pressure on prices. UBS notes that this rebound in manufacturing activity, combined with a more favorable interest rate environment, could lead to greater inflows into silver-focused, exchange-traded funds. China's economic policies are another critical factor in the bullish outlook for silver. The Chinese government has implemented a range of stimulus measures aimed at reviving its economy, which has been under strain in recent years. Given that China is one of the world's largest consumers of silver, particularly for industrial use, these policies could provide a strong tailwind for silver prices. However, The analysts also caution that several risks could challenge their bullish outlook. One key risk is that the market has already priced in many of the expected rate cuts from the Federal Reserve. Any unexpectedly strong economic data, such as a positive payroll report, could temporarily strengthen the US dollar, putting downward pressure on silver prices. Now, we'll show you the best clips of the latest interview, but first, subscribe and hit that notification bell so you don't miss any recaps. Enjoy the episode.
The peak for a long time. I mean, Americans have lived beyond their means for decades now. We've relied on the crutch of the reserve status of the dollar. That's allowed us to outsource our manufacturing to the rest of the world and run $1 trillion a year trade deficits. We've also been able to run massive budget deficits because we've been able to tap into the savings of the rest of the world. Even though Americans themselves don't save, we have a record low savings rate, we're all able to go out and borrow money. Well, who's doing the saving? There's got to be a saver for every borrower. And so it's the world that has been saving and producing. They've been producing the goods that we consume and loaning us the money to pay for it. And so we've had this artificial standard of living. We've lived beyond our means, and that's going to come crashing down. When foreigners no longer want the money that we print, that means we lose access to the goods they produce, and we lose access to their savings. And now we have to fend for ourselves, and we can't do it right now. As much as, Donald Trump wants to talk about making stuff in America, we can't make stuff in America without the factories. And the factories aren't there. They have to be built. The supply chains aren't there. They have to be redeveloped. The skilled workers aren't there. They have to be trained. Where's all this money going to come from to do all this, and how long is it going to take? Right? It took a long time for our industrial base to disintegrate. It's going to take a long time to build it back up again. And it's also going to take a completely different economy. We're going to have to save more and spend less, which means a massive recession because 70% of our economy right now is spending money. That has to stop. We have to save money. And in order to get that to happen, interest rates have to be much higher so that people are encouraged to save, so that we can take the savings and rebuild our manufacturing. But then people have to stop spending. And again, higher interest rates means stock prices have to come down. Real estate prices have to come down. That's a problem because banks are going to fail when that happens. And government's going to have to cut spending. Government's going to have to be honest with people on Social Security and Medicare that they're not going to get the benefits that they were promised, that the money's not there. The government actually has to be honest with our creditors, people who own U.S. Treasuries, and say, look, we can't pay. We can't give you 100 cents on the dollar. It's just not possible. Because if interest rates go to where they need to go, we can't service the debt. Let's say interest rates went to 10%, right? Well, and if the national debt is 40 trillion at that time, well, it costs 4 trillion a year just to pay the interest on the debt. Well, we don't have that money. So, so the only way to get back to a real economy is to allow the phony economy to die. But that means a lot of people lose a lot of money. But the alternative is they lose even more because then nobody loses their money, but the money loses its value. So we don't default on the bonds. We don't default on Social Security. Everybody gets their Social Security checks. They just can't buy anything when they take the money to the store.
Wow, what an incredible episode today. Peter Schiff really brought the heat, sharing his in-depth insights on the looming economic crisis and the critical role gold and silver will play in protecting wealth. His breakdown of how the Federal Reserve's policies are driving inflation and setting the stage for a massive financial reset resonated with so many of you. It's not just about predicting the next move. It's about understanding the long-term strategy for safeguarding your assets. Peter laid it all out, showing how gold and silver are positioned to dominate as the US dollar weakens. Thanks for tuning in and sharing your thoughts. Keep the conversation going in the comments below. What do you think about Peter's outlook? Are you preparing for what's ahead? Don't forget to like, subscribe, and hit that notification bell so you don't miss any of Peter's future updates. Catch you on the next one.